Now we proceed to the first panel this afternoon. We move on to how fundraising structures, such as SPACs and even fundraising through blockchain, can best address the issues that were addressed in the previous panel, while maximizing returns for investors. Mr. Yang Eugene, RHTLaw's Corporate and Capital Markets Co-Head and resident SPACs expert, leads this panel. Joining Eugene are Mr. Erwin Lim, Operating Partner and CFO of Novotelus Capital Partners, Mr. Rajiv Dewan, Partner for Capital Markets and Securities of Canadian firm Macmillan Law, and finally, Mr. Ben Tai, RHT Digi Capital's Head of Product and Business Development. Take it away, Eugene.
Thank you very much. Good afternoon, everyone. I hope everyone had a chance to get some lunch, and thank you very much for staying on with us. I think we are going to have a very fast-paced and info-packed session right now. And in fact, this is the only segment of the entire seminar where we are focusing on companies seeking to fundraise. So as introduced, I'm Yang Eugene, and I co-head the Corporate and Capital Markets at RHT. I will kick things off by talking about SPACs regimes across several jurisdictions, which cover the US and, of course, Singapore as well. And thereafter, Mr. Erwin Lim will talk about the pros and cons of a SPACs listing versus a traditional IPO as well as private fundraising. After that, we will shift gears and we move on to Mr. Raj Dewan, who will then talk about accessing public venture capital in Canada, the various avenues that the Canadian boards have to access public capital. Last but not least, we have Mr. Ben Tai, and he will talk about the new frontier of tokenization and listings on a digital exchange. So without further ado, I'll get on with my segment of the presentation. And I'm going to talk about, basically, I'm just going to run through the SPACs framework that we have. As you know, SPAC stands for Special Purpose Acquisition Companies. And several regimes, some of the regimes like the US have had it for quite a while. And regimes such as ourselves in Singapore and Hong Kong, we've just jumped on the bandwagon. So here, I hope everyone can see our screen. And so this, I'm just going to do a comparison of the various criteria for the different jurisdictions. And what's interesting for this one is that in terms of who can invest, only Hong Kong restricts it to professional investors. All the other regimes in the US, the UK, and of course Singapore actually allow retail investors to participate. Moving on, in terms of how much public float there must be, I'll focus actually more on not so much the Hong Kong regime, because that's really for professional investors. But the US, for example, they need 1.1 million for NYSE, the New York Stock Exchange. They need 1.1 million shares publicly held with a minimum of 300 public shareholders. For NASDAQ, across their two boards, they also have 1.1 million shares held between 400 to 300 board lot holders or shareholders. Singapore, we've sort of also followed the 300 public shareholder requirement. And just like a main board listing in Singapore, we need to have 25% of the issued shares of the SPAC in the hands of these public shareholders. Moving on, in terms of the minimum share price, in the US, technically it's a minimum price of $4, both across the NYSE and NASDAQ, but most of the listings there, they have a minimum price of $10 US. In Singapore, it's $5 Singapore dollars, which is what I believe all the three SPACs that have launched have priced it at. And in terms of, is there a minimum amount that must be raised in terms of capital? For the US, for NYSE, they need a minimum market capitalization of 100 million, with 80 million held publicly. For the NASDAQ boards, again, they have several tiers that range between 75 million to 100 million to 50 million. So these are the ones that, again, NASDAQ has, you can choose different tiers to list on depending on what you can meet. Singapore, well, there's no minimum fundraise size, but it has to have a minimum market capitalization of 150 million, which is the same as the main board listing. So actually, in Singapore, we've kept the requirements quite similar to what you need to have to list a main board company. Of course, without the financial track record requirements, because it's a newly incorporated entity. In terms of the warrants, in terms of the exercise price, on the NYSE, they are typically priced at around $11.50, and they're exercisable after 30 days after completion of a de-SPAC, or 12 months from the date of the SPAC IPO, and they typically expire on the 5th anniversary of completion of the de-SPAC transaction or the redemption of the SPAC. The NASDAQ requirements are the same as the NYSE. In Singapore, the exercise price must be the same as the price of the SPAC share, and they cannot be exercisable prior to completion of the de-SPAC transaction. And they also expire. The maximum tenure it has to be stated in the prospectus, and or the maximum time permitted for completion of the de-SPAC transaction. And then in terms of the requirements of the various officers, the directors, the promoters, what is interesting here is that you will see that in Singapore, they actually need the promoters and the directors to have a minimum amount invested in the SPAC. So typically between 2.5 to 3.5% of the market cap, they must have put that equivalent amount of money in there. So they can't just have nothing and just take the 20% promote. So they must have some skin in the game in Singapore. I think the Singapore regulators are trying to balance the flexibility with the fact that they want the directors and promoters to take it seriously and not just get a free ride on the exercise. In terms of the directors, the requirement, here are the various requirements. This is more a matter of governance. But again, here in Singapore, the majority of the directors on the various committees, including the chairman themselves, must be independent. In the US regime, majority of the directors on the board must be independent, and in the audit committee, the auditors must be independent in the US, same as for NASDAQ. In terms of ongoing obligations, and I think this is very much how much of the funds must be held within the SPAC, how much that was raised must be held within the SPAC. In the US, is 90%. It's the same as for Singapore as well. 90% must be held in a trust account or independent escrow account until the de-SPAC. And it must be only invested in cash or cash equivalents or short-dated securities. That's to ring fence and protect the capital that's been invested by investors inside. So in terms of restrictions on the disposal of shares and warrants, in Singapore, it must be held all the way until the completion of the de-SPAC transaction. So that is to ensure that the promoters don't bail out of the SPAC before completion of the de-SPAC. In terms of the de-SPAC itself, this is just whether you need to appoint a sponsor in Singapore. Again, the answer is a clear yes. You need to appoint a financial advisor, which is pretty much the equivalent of a issue manager for an IPO. It must be a licensed capital market services license holder in Singapore. And of course, the new entity coming in must meet the listing requirements for Singapore listing. think in the US, I believe it's a little bit more flexible. They treat it a little bit more like an M&A transaction, but in Singapore, basically it's treated like an IPO or an RTO for reverse takeover for the de-SPAC company coming in. The size of the de-SPAC target in Singapore, as in the US, it is a minimum of 80% of the proceeds held on trust. For dilution, again, here in Singapore, they they it, not more than 50% of the post-invitation share capital in terms of the conversion of warrants. So they cap the dilution from the conversion of warrants, and also the promote is also capped at 20%. That's very common. In the US, they have the same thing as well, 20%. Although it's not a hard rule, but I think the practice is 20% of the promote is the norm in the US. And this is just who can vote here in Singapore. Majority of shareholders can vote, although it has to be recommended by the independent directors. And of course, in special cases, and we get this question a lot, actually, people do ask whether they can sort of set up a SPAC and then, inject assets which they also control. The answer to that is yes. But of course, all the IPT rules, interested person transaction rules in the listing manual in Singapore apply, and any conflicts of interest must be disclosed and dealt with in Singapore. It is allowed, but conflicts of interest and IPTs must be dealt with properly. Okay, and at the end of it all, in terms of time frame for the de-SPAC, in the US, it's 36 months, although quite often they do set it voluntarily at 24 months with an option for extension. In Singapore, it is actually phrased slightly differently. It is 24 months, but if you have entered into a binding agreement towards the tail end of the 24 months, you do get another 12 months, with the approval of shareholders and the exchange. Yeah, so that actually brings me to the end of my presentation, and I'll pass the floor now to Erwin, who will do a comparison between SPACs and IPOs and private fundraising. Erwin?
Thank you, Eugene. Where can I see the slides? Just give me a second.
Can someone put Erwin's slides up, please?
Yeah, thank you. Is everyone able to see the slides? It's up?
Yes, we can see your slides now. Yes.
All right, great. I will touch on the comparison between having a SPAC and other forms of fundraising, like private equity, venture capital, or traditional IPO. So this is more to give people an idea of what are the advantages and disadvantages of each of these form of fundraising or traditional fundraising. For private fundraising, the advantages is that basically you can raise funds relatively quickly if you are a good company, have good growth potential. The terms meet those that is required by the investors. It can be about 2 to 3 months, typically in terms of timing, getting all the sales contract done. You can get your funding within 2 to 3 months. And also because typically every private deal is quite customized in nature. You can actually negotiate and structure a deal that's satisfactory to both the investor and also the company. And it can be quite highly structured for both parties. You can have warrants, etc. All can be very simple, right? So as long as both parties agrees, shake hand, and the deal can be consummated. The disadvantage of private funding from VCs or even private equity is typically this is not a very long-term arrangement because the private equity and VC, typically their funds have a lifespan, right? So it could be 3, 5, 10 years lifespan. And when it comes closer to the end of life, and also it depends on when your investment was made within their life of their fund, you could be faced with some pressure to exit very soon, and this may not be something that you wish for, or from the company perspective that you may not wish for. Whereas for a SPAC is a bit different, because for a SPAC, the sponsor, who could be a PE company or VC company, it is public listed and they could exit anytime if they want to, after their moratorium has ended. So the next disadvantage is that because of a complex capital structure, typically if the VC has invested in the company, they typically require quite a lot of minority protection clauses, within the terms, right, and the agreement which you have to abide by. And if the direction of the management and basically the sponsors, the VC or PE, is a bit different, this may not lead to actually very collaborative board, put it this way. And also, if the company is not doing well, because it's really hard to tell in terms of global cycle and macro events that happen. For example, recently, the Ukraine and the Russia war would have created a lot of problems for a company who has investment either in either of these countries, or who have businesses selling to those countries. You are faced with some issues, and if you require additional funding during this period of time, it's typically quite difficult for private equity or venture capital to try to justify to put in money unless they can see some kind of a short-term horizon when things can turn around, and so on and so forth. So coming to the next potential fundraising, which is a SPAC company. The advantages, of course, in Singapore SPAC is obviously Singapore is positioned as geopolitically neutral place for SPAC listing, and that's why the SGX wanted to start this. And I think there's some reports that this is a new product in Singapore, and the SGX hope that it can be as popular as the REITs. And obviously, our company, we are one of those three that has listed a SPAC in Singapore. And in terms of Singapore comparing with the US, I think of course, US is the more popular place for SPAC. They are the one that has driven the whole SPAC market. But for companies from certain countries, example like China, they may have a bit of a concern due to the geopolitical issues to de-SPAC in say like US. Or vice versa, a US company may have a bit of concern to de-SPAC, say like in Hong Kong or certain other markets. Whereas I think in that case, Singapore actually stand out as a pretty neutral place where most where de-SPAC target from most countries can actually come here to de-SPAC, and also at the same time, Singapore provides a high level of governance, which is, I think, well known globally. And of course, for the de-SPAC asset, this is a fast way to IPO, right? You take few months, 4 to 6 months, typically shorter than an actual IPO that a company planned to do, which would be 6 months to a year, roughly around that kind of time frame. And the other point is that for de-SPACing, I think it is helpful to reset the capital structure of the asset, because in that sense, what it meant really is that it enables some minority shareholders to cash out. Some, potentially there can be minority shareholders, who are not really involved in the management. They may be early investors, and this is the opportunity for them to cash out at a reasonable valuation and take the cash and exit the company, and also potentially the promoters or the shareholders or major shareholders may want to cash out some. So this structure can be negotiated with the SPAC management and come to some form of agreement, before the de-SPACing process, right? And of course, the biggest benefit for the company is that they get access. I mean, I'm just making an example of a typical amount of money raised between 150, 200 million IPO in Singapore. They get access to this 150 to 200 million dollars without, having some market risk, which I'll come to in the traditional IPO. And of course, working with the sponsor, so far, the SPAC is listed really and raised the amount of money raised 150 to 200 million by the three SPAC that's listed. A lot of it is really based on the reputation of the sponsor, and of course of the type of investment that they are doing, because and obviously what the investors can rely on the historical performance of some of the sponsors and the track record, obviously, to raise the amount of money, and obviously there's some faith put into other sponsors. And so I think some of these sponsors, from the SPAC company perspective, is good to partner them, because they can add, I think, pretty good advice or value creation strategies to the ultimate combined company. So this is the other advantage that I think for SPAC or the SPAC company. The disadvantage, obviously, for a SPAC company is, well, you're going to be publicly listed, and there are announcements and reporting required for any publicly listed company. So this is not anything that is very unusual. And of course, for the SPAC to happen, typically for the SPAC itself, the IDs, who are usually the controlling or make up the majority of the board of the SPAC, will have to approve the SPAC deal, followed by an EGM, which the shareholders will have to approve. Because the money itself, as what Eugene said, is kept in an escrow account that basically nobody can touch it until the SPAC happens. Right. Moving on to the traditional IPO itself, obviously there's certain advantages. The advantages are that well, if you don't need a sponsor, the company can go IPO itself. And there's one of the advantages, obviously, there's a bit less dilution than partnering a SPAC. So I think the company thinking of going through a traditional IPO have to think about this. Whether they need a partner to add value, whether they need quick access to money and they need a shorter time frame. Some of these pros and cons, I think the company itself will have to kind of weigh. The disadvantage, obviously, there's the risk of IPO. I mean, for example, you try to IPO during this time when there's a war, between Ukraine and Russia, and then obviously the market is kind of volatile, and your investment banker will tell you probably not to do it now, and maybe consider it 3 to 6 months down the road. So in that sense, if you need the money to grow, then there will be a bit of a situation where you might be kind of stuck, in terms of funding. And of course, the IPO process will take longer, 7 to 10 months. Besides writing the IPO prospectus, you need to audit or get it properly audited, the company, and so on and so forth. And the various professionals will be doing some form of due diligence on the company. And of course, maybe there could be some restructuring that might be required, that might make the process a bit longer, right? There are certain SGX requirements, for example, like 3 years profitability or certain market cap requirement to IPO on the main board. So the SPAC is actually a main board listing. It's not a catalyst listing. And obviously, when you IPO, you need to run the roadshow. Certain management are good at are good operators of the company, but they are not good financials or marketing guys in terms of the financial market. There's a bit of division of labor, but some people think that they can do it. And I've seen companies, management who are operators, but they are equally good at fundraising. So I'm not saying that this is not an avenue that a company can pursue, but certain companies, they prefer to focus, or founders or management prefer to focus on their operation. And in terms of IPO, you need to market, and there's a certain date where you can market, and of course there's some uncertainty. If there's, for example, if on the day that Russia marched into Ukraine, and there's your day of IPO, and I think you probably have to scrap the IPO. So there's some risks. Whereas for SPAC, you don't have to face this risk, right? You can choose a time. You can combine even now with all this uncertainty. Obviously, there might be a bit of hit on the market, but at least for the company's perspective, you get a cash, right? And obviously, if additional cash is required, you can always raise it from the market either via debt or a pipe deal. Okay, next slide, please. Okay, moving on, I'll just touch a bit on the de-SPAC process, which I've kind of touched on, but I'm just trying to illustrate. So for example, like today, if you have $150 million cash, for example, for the SPAC company, SGX main board listed, and with a sponsor, qualified sponsor, and then of course a de-SPAC company, a target, there's an operating company, and typically the de-SPAC, the company will be 3 to 5 times. This is a rule of thumb in terms of the market size for the company to be de-SPAC. And of course, the company would have, the sponsor will look for a company that either fit their investment criteria or has some growth prospect. Because I don't think anyone wants to invest in a company that doesn't show any potential growth, because then that will not be a proper way of SPAC governance, put it this way, right? And the negotiation process, I would envisage, might take about, once the de-SPAC target has been identified, probably about 1 to 2 months. A bit of due diligence by the SPAC company, discussion of valuation, timing, how we're going to use the fund, and so on and so forth. And then, this is coming, the 1 to 2 months is the timing required to more or less come to a term sheet stage. And then probably 4 to 5 months in terms of, getting the circular done, because you need an EGM to happen, getting the necessary approval, probably a bit more detailed diligence during this period of time. And, within 4 to 5 months, this whole de-SPAC process should theoretically close, right? And sometimes in the de-SPAC process, the de-SPAC asset may actually require more funding. And as I mentioned, we can do it to a pipe deal, basically place out more new shares to the market. And obviously the advantage of merging into a listco is that when you want debt financing, I think it's probably a lot easier to get debt financing. And at the same time, for the sponsor and the management, the key management of founders, you don't have to give a personal guarantee, right, to the lenders, because you are a listed company, right? And you have a lot more alternative ways to raise funds going forward. Okay, in terms of the last part, in terms of grow, and obviously, I think most SPAC sponsors would want to continue to partner the SPAC target to grow the company some more, basically to create a win-win for both parties to increase the valuation of the company. And obviously the focus will be on things like customers, market networking that the sponsor can actually bring to the combined entity, and generally to create a lasting equity growth and a win-win for both parties. Okay, I think that is the end of my presentation. Thank you.
Okay, thank you, Erwin. Thank you very much for that. And now, as promised, we will shift gears and we move on to Raj, who will then talk a bit about his jurisdiction in Canada and what it has to offer. Raj?
Oh, thank you. Thank you. And I see my slide there. So good afternoon or good morning for all of you. I'm currently in Toronto, and so I'm going to talk briefly, and I know the time is limited, just about some of the opportunities for companies in Asia for raising growth capital and what we call public venture capital in Canada. So some of you might wonder kind of what the connection between a Canadian law firm in Asia is. And so very briefly, we're actually the only Canadian law firm. We're a full-service business law firm. Our offices are across Canada, but we're actually the only Canadian law firm with an office in Asia. We've had an office in Hong Kong for almost 10 years, and we've been very well established in the Hong Kong and the Asian ecosystem and working on cross-border transactions. And so we have my practice is largely focused on working with what I call knowledge-based companies or high-growth companies. So I'm sure some of you in the audience today fall into some of the industries which the slide highlights. In terms of our practice and our client base, just a quick snapshot of some of the companies that we worked with across Asia, across sectors on cross-border transactions, listings in Canada, and even listings in Asia. And as some of you may know, there is also a deep connection between Canadian companies who actually operate in both Singapore, Hong Kong, and throughout the ASEAN, and we just wanted to highlight them. And CPTQ, Brookfield, OMERS, TD, and Manulife are on the ground there, we know, in Singapore, as long as CIBC, very well-known established Canadian companies. So I'm going to kind of skip through some of these slides, which the organizers have available. The one slide I would highlight is that you'll notice that we have a very strong ecosystem in Canada that focuses on innovation, and some of the names that I've put down in this slide hopefully are familiar. And these are companies across. These are companies in Canada that have done very well and that are well known. And so I think the point here is that for companies in Asia in technology, there is a very well established ecosystem here for them to come to and explore opportunities to grow and to do business. Canada and Singapore have a very strong tie. There's a number of initiatives, both governmental and from a policy perspective as well through the private sector, that have been established. I'll try to highlight some of those. So public venture capital, what does that really refer to, and why are we here? The one key message I would say is that the Canadian capital markets have historically been very conducive for raising capital for what we'd call companies that are looking for public venture capital, alternative sources to what is traditional private capital. So what we have in North America and primarily in Canada is a very conducive market among institutional and high net worth investors who are prepared to invest risk capital in companies that are looking to go public. And so what investors are looking for is to invest in companies that have a near-term liquidity plan. So if you look at some of the statistics which are highlighted, hopefully you can see this in the slide on the right, and these statistics kind of highlight from 2021 the industries, but also the capital that were raised. And this is a snapshot for two of the exchanges in Canada, which operate under one corporate group called the TMX group. But you'll see, I think one of the key things that may kind of people in Asia may kind of appreciate here is that the size of the financings which happen in Canada are really reflective and consistent with companies that are growth-oriented companies, smaller amounts. And there's reasons for that, which I'll get into in terms of our listing requirements. And in terms of industries, you'll notice that, and I'll talk about CPCs in a bit, but it's really mining, which has been historically a very strong capital market in Canada worldwide, technology and life sciences. And there's, a lot of those that they have been very active. We saw in 2021 a very robust capital market. So the Canadian market, smaller, think about it in these terms, smaller amounts of capital that are being raised for companies that may not necessarily meet the listing requirements of NASDAQ or equally of those of other international stock exchanges. And so the value proposition in part of what the Canadian market tries to impart is that this is a market where you can go get listed, learn to become a public company, grow as a public company, and ultimately explore opportunities to go to NASDAQ, go to Hong Kong, go to SGX, go to NYSE, or even go to London. And there's examples of companies that have done that. And there's one case study that I'll highlight for you. So we have, fortunately, in Canada, we have kind of 4 exchanges. TSX is kind of the equivalent of the main board, senior listed companies. TSXV really deals with growth-oriented companies, and TSX and TSXV, for those of you who don't know, are owned by the same corporate group. And so they're companies that have listed initially on TSXV, have raised more capital, grown their business, and ultimately gone to the TSX. NEO is a relatively new exchange, and they have been largely focused on structured products, ETFs, but have also launched kind of what they call a mini SPAC regime called a G Corp, and I'll talk about that shortly. The CSE positions itself as the stock exchange for entrepreneurs, and so similar to the TSXV, it has proven to be a very successful listing platform for growth-oriented companies that may not meet the senior listing requirements, but are looking to access liquidity in the capital markets. Sorry, I'm just going to the next slide here. So TSXV, so the TSXV Capital Pool Company, this is probably what I would say is one of the most successful listing structures that the Canadian market has put together. And it's similar to a SPAC regime, but also a little different. So conceptually, what a capital pool company is a blank check company that has been primarily created for the sole intent purpose of acquiring a private company. And so in Canada, you have to appreciate, and I think Erwin, in his presentation, he highlighted, one of the key points he highlighted when you evaluate SPACs versus an IPO is that inherent in going public via an IPO is there's a lot of market risk. So the Canadian market, I would say, 80% or more of companies that go public actually go public through what we would call a reverse takeover, either with a CPC, which is a capital pool company, or kind of a dormant or a shell or so, or listco that needs to be repositioned. So the CPC allows you to raise up to $10 million. It allows you to go out and acquire a private company that then becomes public. And that the value proposition for the private company is that it inherits a public company status. So it doesn't have to do an IPO. It inherits a shareholder base which meet the float requirements of the stock exchange, and therefore they don't have to worry about doing a distribution round. And it allows them to then proceed as a listed company. So it is somewhat similar in concept to a SPAC because it's a listed company created for the sole purpose of acquiring a private company, albeit it doesn't have some of the constraints and restrictions and quite frankly the level of requirements which are applicable to a SPAC. So there's you don't have, in Canada, that SPAC has to be at least 30 million. In other jurisdictions, 100 or 150 million. There's no right of redemption. Because the capital pool company has been primarily created for the purpose of going public and acquiring a private company, unless it involves a related party who's a shareholder, director, officer on the capital pool company, the target. In the absence of that circumstance, you actually don't need a shareholder vote in order to complete that transaction, because that company was created for the sole purpose of acquiring a company to go public. So just to give you some handle on the statistics and the success of this listing route, I mean, you could see on the slide there's a snapshot of some statistics which, you know, demonstrate that, you know, over $75 billion of equity has been raised through this route in the Canadian markets. There's been over 2,600 CPCs created, and a number of these companies have actually graduated and gone on to be included in part of the indices in Canada for more established and senior issuers. So very well known, very well established route for going public in Canada. As I mentioned, we do have SPAC rules in Canada, and there have been a handful of SPACs which have been listed in the Canadian markets. I would say that probably if we had a client that was looking to raise a SPAC, I think it would be, and we're looking at, you know, a company that had an enterprise value of greater than 100 million. You know, generally, I think the view is in the market, in the Canadian market, that you just have so much depth and such a critical number of SPACs which have listed in the United States that it's quite difficult for the Canadian market, absence, you know, unless there was a very key Canadian sponsor in the SPAC to counterweigh the depth and the success and the number of listings you've had in SPACs in the United States. And as a result of that, we've only seen a handful of SPACs in the Canadian market. And it's also a function of the fact, quite frankly, that the sweet spot for Canada in terms of raising capital is much smaller than the United States, given the relative size. And therefore, the SPACs, because they cater for larger transactions, just have not been it's not compelling to outweigh going to the United States if you're in North America. As I mentioned, the Canadian Securities Exchange has been a relatively new exchange, under 20 years, has been very successful. A lot of its success over recent years has been focused on companies from the United States in the cannabis sector that have gone public. And if you look at some of the statistics that are associated with this exchange, notwithstanding that it caters to much junior listing requirements. You know, if you look at the working capital, if you look at the net tangible assets, and you compare those requirements relative to other senior exchanges in North America, Canada, or in Asia, you know, those requirements aren't as stringent, but there is a sufficient amount of liquidity and volume and value of stock which has been traded on that stock exchange, which only really validates, quite frankly, that there is a very liquid secondary market in Canada or North America for small, medium cap issuers. The NEO exchange, as I mentioned, is a relatively new exchange, and they saw an opportunity earlier last year where they said, look, SPACs kind of cater to companies that are very large. CPCs in Canada cater to companies inherently are a little smaller. So they saw an opportunity to create what they call a G Corp. So a G Corp is kind of a hybrid of a SPAC, effectively a SPAC regime with lower requirements. Key requirement being lower market cap requirements relative to SPAC requirements in other jurisdictions, and also they kind of take away the right of redemption. And so, as Erwin pointed out in his presentation, one of the key deal risks on any SPAC is not understanding ultimately what the amount of capital that's going to be left in upon the de-SPAC transaction, because by design there is a right of redemption. So that is an interesting space that we'll see how as it evolves in the Canadian market. There's only been one to date, which has been sponsored by a very well-known investment bank. So I think as the market gets more depth, we'll probably see more G Corps in the Canadian market. Very briefly, MJDS is a route which essentially think about it as a streamlined regulatory route between Canada and the U.S., and it allows Canadian companies that meet certain listing requirements to actually fast track to get listed in the United States. on the back of the Canadian disclosure document. So it's a very unique and novel arrangement which only exists between Canada and the United States. A number of companies have gone public through that route and listed in the United States. As I mentioned earlier, I think, we see the flow of listing as being complementary and evolutionary. And what I mean by that is, every market has a strength and a weakness. And our view is that, certain markets, for example, the Canadian market may be the more conducive market for a company that's smaller, earlier stage to go public, but ultimately and eventually as it succeeds and grows, it's going to move on to other markets, whether it's NASDAQ, whether it's SGX, or whether it's Hong Kong. So I'm going to quickly just run into a couple case studies, which I think may prove useful, just to highlight a few things. So VIQ Solutions. VIQ Solutions is a client of mine. I got involved with them in 2015. They were doing under 10 million in revenue, under 10 million in market cap, stock prices at 4 cents. They used the capital markets to effectively implement a consolidation play where they were acquiring a number of competing companies across jurisdictions. And so they ended up raising, they raised a substantial amount of money. They are now listed on NASDAQ. And it's a great example of a company that's kind of evolved through the Canadian listing framework from being on Venture, going to TSX, and ultimately on NASDAQ. There's a CPC case study, which I know we're pressed for some time, so I'm going to flip over. But the one I did want to highlight is this company, which recently listed in Canada, based out of Taiwan, called Just Kitchen. So Just Kitchen is an interesting company, right? They've raised over $30 million since they've been public in Canada. They raised $8 million as part of the go public transaction. When they listed, they had a revenue of approximately $1.8 million, and they've doubled. And so they've done a number of very successful things. They've grown, notwithstanding that they're based in Asia. They've actually grown and flourished in the Canadian market. So I'm mindful that I may have run over my time, but hopefully this is useful, and I know the team at RHT will have these slides available. Thank you.
Thank you very much, Raj. Thank you for that. A very informative explanation of what you can do in Canada. It's very exciting. Yes, we are kind of running out of time, but I would like to pass the floor now to Ben to very quickly talk about a very different form of fundraising, and that is through tokenization and the potential listing on the digital exchange. So these are all potential avenues that companies can consider to fundraise. So we're trying to give as many options as we can. So we'll leave it to Ben now to take this away. Thank you very much, Ben.
Thank you, Eugene. Okay, with the advent of blockchain technology and using that as the foundation of building blocks, we are seeing increasing adoption towards the tokenized economy, and with that giving us the tokenized asset and the evolution of a wider scope of assets, including security token offerings, which is a subset of what we are seeing. So what are security token offerings? I think one of the ways to see is to map it to traditional instruments and then using a wrapper analogy, which we'll go through some examples. So for example, traditionally, when we have the underlying asset and we use a note as a wrapper, we will give rise to the asset-backed securities, or what's commonly known as ABS. And with that, subsequently, with the evolution, we are seeing it being used, trust being used as so-called a wrapper, giving rise to the real estate investment trust, or what's commonly known as REITs. And for now, we are seeing people using token as a wrapper, giving rise to security tokens offering. So maybe just a very generic process of how it will work. So essentially, usually the asset owner will come to us with some asset they would like to tokenize. And basically, the token issuer will do an initial assessment. And depending on the parameter, if it's not accepted, then the deal is rejected. But as we mentioned in his presentation earlier, in the private market, including STO, they offer very customized solution as well. So there's always room for further negotiation between the asset owner as well as potential investors. If it is accepted, then the token issuer will gather preliminary investor interest. Subsequently, doing the due diligence. Okay. Once agreeable, they will negotiate the final price between the asset owner as well as the potential investors. The token issuer will then set up an SPV to acquire the property or the underlying assets and issue the STO. The token issuer will then decide which digital asset exchange to list, and subsequently the STO are listed on a digital asset exchange. So this is a summary of the flowchart that just gone through. Just quickly, just on the SWOT analysis, just one point to add is that, of course, with the STO space and all this tokenized economy is still evolving. So some of this parameter may move across the quadrant as we progress along. But just quickly going through in terms of the strength, the highlighted words are usually what we come across in our conversations or what is commonly mentioned as well. So in terms of strength, one of the big points is, of course, transparency on the blockchain as well as reduced transaction costs. Weaknesses-wise, some may not be familiar and so on, and of course, the regulatory uncertainty. Opportunity-wise, besides the flexibility, being able to tap new investor segment, we are also seeing greater flexibility in terms of the project size to be as low as 5 million, and also similar to what we mentioned in this presentation earlier about the advantages of a private market and issuing through STO. And the threats primarily is also the regulatory uncertainty and framework as we continue to develop this space. Right. So last but not least, I guess one of the advantages is the flexibility. We can use STO to tokenize real assets, for example, real estate or commodities such as gold bars, luxury items such as watches and so on, artwork. We can use STO to tokenize bonds or company shares, including tech companies. We can use STO to tokenize even cash flow of certain projects and so on. So that's the advantage of having the flexibility as well as very customized solutions to meet both the investor as well as the asset owner's needs and profile. So with that, I'll hand it back to Eugene. Thank you.
Thank you, Ben. Thank you for the whistle-stop presentation. But really, I think unfortunately we are running very short on time, and we may not have time for Q&A right now, but I would encourage everyone, if you're available, to come back at 3 o'clock to the breakout networking session. And then you can further the conversation and as well as ask any questions that you may have on any of the presentations that were made today. So I think, I believe the organizers would want to move you on to the next presentation. So I think that only leaves me to thank everyone for taking the time to attend this session, and of course to thank very much our speakers and panelists this afternoon for being with us here. And we hope to see you all again later at 3 o'clock. Okay, with that, thank you very much. I'll hand it back to the organizers. Thank you all.
Thank you, Eugene,
Thank you.
Irwin, Rajiv, and Ben for sharing on fundraising structures that can be used for tech investment.